Let's dive into the world of stocks together. Starting off with the basics and the most basic question, what is a stock? No, it isn't what you get when you go and buy some celery at the grocery store. Stocks in this context are something that goes by many different names. Stocks, shares, or equity, but all of them refer to the same thing. They are small pieces of a company. All corporations are broken up into a bunch of small little pieces of a big pie, and each one of those slices gives you partial ownership of that pie. Meaning, by owning a piece of stock, you are technically a part owner of that company. And certain companies, known as public companies, allow people like you and me to buy stock into that company, letting us take advantage of ownership where if the company makes profit, we are profiting as well. But if we want to buy the stock for example, Apple, you don't run out to your street and start yelling, buying Apple. Chances are you're probably going to end up with some fruit. But if you went to the stock market and yelled, I'm buying Apple, they're not going to give you Apple. Because instead, what you would need to buy is the ticker symbol, or the nickname for Apple, which is AAPL. Every publicly traded investment, stock, and some more complex versions of investments that we're not going to get into today, have ticker symbols, or unique names that let us know exactly what we're talking about, so we can tell the difference between Apple's and Microsoft's. Some of these tickers are going to be very obvious. Ford, F. Tesla, TSLA, Amazon, AMZN, Microsoft, MSFT, and more. Some are a little bit less obvious. For example, ExxonMobil, the gas company, XOM. Coca-Cola, I don't know where they got the K from, but it ended up in their ticker symbol, KO. And then finally, Salesforce, CRM. That one is actually pretty creative if you know what a CRM is. If you don't, it makes no sense whatsoever. But regardless of what we're calling them, if we want to call them AAPL or Jeff, the main thing we mostly care about is the value that that stock has. These pieces of a company are given value based on how much people think the company is worth, and furthermore, how much they're willing to pay for that piece of the company. If the company is doing well, the value of that stock will typically go up. If the company is not doing well, the value of that stock will typically go down. So the idea of stocks is having the ability to profit off of a company's success, which is why many people choose to use stocks as one of the most common types of investments they take advantage of. So why are stocks so popular? Well, the main reason? It's a way of generating return or interest on our money that isn't tied to whatever interest rate a bank is willing to give you. Instead, our returns or our profits are tied to the performance of the company. Now this has some benefits, which is the fact that sky's the limit on how much profit we can make. It's only limited by the profitability of the company. But the drawback is that there is no promise that that company will go up in value, nor that its share price will go up in value. So, now we start to get into some territory where there is slightly higher risk, but it comes with slightly higher return. And by making smart choices and understanding the market just to a basic level, we can find companies that will go up in value over time, helping us profit as a result.